Okay, welcome back to Rockstock Channel. It is Tuesday, February 27th, and around 12 o'clock in the afternoon. We are very privileged to have back on the podcast David Deckelbaum of TD Cowen. Cowen has been bought by Toronto Dominion Bank in Canada, and he's going to talk about U.S. equity market sentiment, not only to lithium companies, but a bit like the broader EV thematic, because that's been a big headwind, in the United States with Tesla and Rivian and a number of stocks down. But more than that, he's going to talk about post earnings season. Almost all the earnings are out. Um, his stock, the specific recommendations on Albemarle, Arcadium, Piedmont Lithium, Lithium Americas Argentina, and Lithium Royalty Corp. Before we begin that, I'm just going to mention Lithium Royalty Corp. I just want to give a heads up or a shout out to our sponsor, ticker symbol LIRC. It's on the Toronto Stock Exchange, market cap about 370 million Canadian. It has royalties on over 30 companies, including Sigma Lithium, as well as Winsome Resources. We'll have a bit more about that later in this podcast. I also want to just remind everybody to register their email at rkequity.com if you want to get our Lithium Ion Bull monthly published directly to your email box. And if you like this video, please like and subscribe and comment. And also just let us know in the comments below, what you think of David's commentary. Do you agree with his stock ideas? And what other guests and topics would you like to see Rodney and me cover on Rockstock Channel in the future? You can follow Rodney and me on X at Lithium Ion Bull and at Rodney Hooper 13. And of course, you could listen to audio versions of this video on Spotify and Apple Podcasts. And we'd appreciate if you want further deep dives with Rodney and me to consider subscribing to us on Patreon at the $100 and $300 tiers. We had our group call last week, and we have been undertaking our one-on-one calls with our Patreon sponsors, in the past kind of couple of days. Before we go into David's commentary, I'm going to make some introductory comments because lithium prices, have been ticking up a little bit. Recall the Sir John Templeton's famous phrase, the next bull market, is born on pessimism, then grows on skepticism. Matures on optimism and dies on euphoria, but we're still, in pessimism. Maybe we're growing on skepticism. But importantly, commodity equities follow commodity prices. So a number of stocks are up 30, 40% off of their lows, and lithium futures and spot prices have been ticking up. As I said, the last few days, pushing over, 100,000 renminbi, in some cases. And the futures markets are substantially in contango with the CME, with prices a year from now in the $19 to $20 range, for the hydroxide, up from, 12 or 13,000 now. But lithium watchers are right to be skeptical. Is this a sustained rally, or is it another head fake before another leg down? Goldman Sachs, who has called this market right, perhaps for the wrong reasons, reiterated their bearish lithium view last week, suggesting $11,000 carbonate by the second half. Rodney and many others disagree. With various USA and European headwinds, what happens to lithium prices and equities in 2024 will be dominated by demand and supply in China. On the demand side, there's been a lot of good news flow out of China in recent days. CATL is painting a picture for battery prices falling below $50 a kilowatt hour. In 2014, Stanford professor and clean disruption guru Tony Seba predicted the market would offer 200-mile EVs for US $11,000 by 2025, which would be cheaper than even low-end ICE vehicles. BYD, 1 year ahead of that curve, has introduced a Corolla killer cars, priced as low as $11,000, in some cases $15,000 in China. These are attractive cars. We're hearing from, a number of our channel checks. These are not the glorified golf carts like the Wuling Mini, of 2 years ago. Rodney and I are speaking daily with our contacts in Asia, Europe, and North America, procurement people at non-Chinese OEMs, Korea and Germany in particular, recognize the time is now to secure big, long-term lithium supply as early as 2027. But will their bosses and bureaucratic infrastructure at these major OEMs enable them to seal more deals? I wouldn't be surprised to see some billion-dollar deals later this year. Strategic deals between major lithium producers and the biggest lithium purchasers in the world, potentially following GM's footsteps into large greenfield operations like Lithium Americas, going up all the way upstream to mining. On top of the supply cuts from major Western producers, which Rodney has discussed already and will continue here with David, there have been many positives on the supply side we're hearing from China in recent days, which I'll discuss in a second. But one negative that seems to remain in place is the destocking of batteries, a destocking caused by many battery and EV producers in China in particular going bankrupt or consolidating and having to sell battery inventory at a loss. This supply could put a wet blanket for another couple of quarters on what otherwise might be a sharp price rebound. Time will tell. But there's been a multitude of factors impacting China's supply, potentially meaningfully. First, we're hearing that colder than usual weather is affecting Shanghai brine production. And there's been discussions that Ganfeng is having a huge retrofit for 2 months, and Tangxi is doing rotational retrofits at its plants. Sichuan is suspending production until March 31st. This is quite normal, for lithium refiners to conduct these retrofits in the first quarter, so it may not be a long-term price support, but nevertheless, some of our Asian broker contacts are saying this is underway. And there's been further news that China is stepping up scrutiny of over-exploitation of Shanghai brine, which could have a potential supply impact, and increased environmental scrutiny of Shaanxi lepidolite. That's been confirmed, although we have yet to see official confirmation that CATL's lepidolite mine is shutting down. But definitively confirmed is the Ministry of Ecology and Environment, which is a central government level, has informed the local Shanghai government on February 26th that there was no material improvement in the overexploitation of the brine. All Shanghai brine producers were named and shamed by this government body, which could have a 2024 lithium supply impact, according to this broker, of up to 130,000 LCE. The scrutiny of the lepidolite mines could impact as much as 131,000 tons of supply. So combine up to 260,000 tons of lithium supply at risk due to government paying attention to overexploitation of brines and, dirty lepidolite production. But again, there hasn't been confirmation of the CATL project being cut. The bottom line, according to this broker, environment and safety is a rising topic on the China's lithium agenda lately. It's not necessarily a paradigm shift, they argue, because China has always been more ESG aware than people think. But nevertheless, there's been a huge increase in supply based on this huge price rises that we've had in the last few years. And it's now caught the government's attention that it's not all clean and they're doing something about it. So this, on top of all the cuts that Rodney and David are going to talk about, we've seen from all of the Western producers, could have a major impact to lithium prices this year. And with that, welcome, David, back to Rockstock Channel. And let's start, as I mentioned, as the negativity, which has been pervasive for over a year or longer, in the United States, is it still there? What are you hearing? Because you've had lots of calls with investors, post Albemarle and Arcadium's results.
Yeah, sure. Thanks, Howard, and thanks, Rodney, for having me back on. Well, I think on the institutional side, which is where most of our customers are, I think there's still a relative pervasiveness of negativity. And I think it's not so much that things would get precipitously worse. I think it's more just trying to time or really ascertain the duration of this, arguably lower than incentive price levels, and how long it would take to, in your opening comments around just business cycles and the next bull market being born out of pessimism. It's just a matter of how long is this pessimistic period going to last? And I'd say it's still very much present I think there's so many external forces that affect you, right? We're in an election year in the United States. I think you've undeniably seen, Ford and GM and some others pushing out production lines. You've seen some delays with battery plants. Yeah, I think like the entire construct of the IRA, like the pie in the sky prognostications of really building out, um, a very secular supply chain, ex China, some of those expectations are being rationalized. So I think it's that pessimism hasn't completely abated just yet. But we obviously are coming off of a time where the U.S. was up 45% last year in terms of EV deliveries. I think we're not going to see those levels in 2024. I think we all look at like EV deliveries as an indicator, and I think holistically across the world, those aren't disappointing data points. But yeah, I think that there's so many other questions. A lot of it just around the timing of the supply chain and whittling down the inventories that we see, just both on the lithium side, but also on the battery side.
Do the U.S. Investors, are they paying attention so much like what's happening in China, or are they, they're still thinking about, Ford, GM? What's interesting, Morgan Stanley had this chart that like Ford and GM's stock price actually has been performing pretty well, but Rivian, Tesla, and everything that kind of EV correlated has just continues to be smashed. Ford and GM are pivoting to hybrids and, internal combustion engine cars, right? So is there a belief that, things are going to, the whole EV thematic is just, it's not going to happen as fast, or it's not going to be that significant, long
I,
term, right?
yeah, I think. Look, I think that most investors pay attention to what's happening in China, right? But really, the bull thesis of a couple of years ago was predicated on ex-China proliferation, and those expectations are moderating. And look, I think the fact is we all have to be frank with ourselves, and it was always much more pragmatic, especially in the United States, to have more hybrids in the ecosystem than full BEVs. We don't have the adequate charging infrastructure here. Um, and I think, look, it's interesting at the same time, a couple of years ago, manufacturers or OEMs like Toyota, were being heavily criticized for their comments around BEVs. And now they've found some novel applications for hybrids, and some other battery chemistries on the BEV side. I think it's just a matter you're seeing a greater share taken from hybrids, which inherently is obviously worse for lithium demand, in terms of a factor of lithium intensity. But undoubtedly, like the total NEV penetration in this country is going to continue going up. I think it's just a matter of how large do you really need that supply chain to be in the United States, and what price do you need on the lithium side to adequately compete with China? Because I don't think that most investors that were looking at names like Albemarle, or looking at names like Livent before they merged with Allchem, or even looking at Allchem prior for so many of the others, I don't think that their thesis on the long side was to be serving the Chinese government and Chinese battery manufacturers.
Okay, great. So do you think it's a good time to buy lithium stocks? And if so, in order of your preference, let's go through those. Which is your top pick? And would you be allocating fresh capital now, or should we wait?
So the it is a good time to buy. What are your options, right? Compared to every other option that you have in the marketplace. I think you have seen a historical amount of bloodshedding. However, I still think that you still need to see some incumbent producer pain, which has not happened yet. And I think that what you've seen coming out of earnings is that many producers that are, incumbents right now, like the large Australian spodumene miners, did not cut very dramatically. And I would imagine, and if anything, you're seeing, and I know, Rodney, you see your head, because obviously we've seen cuts at Greenbushes, we've seen Wajina being pushed out. Pilbara didn't cut anything. And, I think you're seeing some contentment to keep going along here and just take a wait and see approach. Look, if spodumene prices, if you stockpile here and chemical prices perhaps recover to $18,000, $19,000 a ton, are you going to see spodumene pricing going back up to $1,400 a ton? I don't know. I think in terms of timing, like right now, you are seeing, I think, some short squeezes in the equity market, which is a logical seasonality kind of post Chinese New Year celebration. But I think that there's still a lot of questions that need to be answered here. I think if you have a very long term framework, some of these names, I do not think that you can supply a market that's going to have a 20% plus CAGR on the demand side through 2030. I don't care what the Pidilite prognostications are or what you're expecting of Chinese brine. You cannot meet that demand with lithium pricing at $14,000 a ton. So I think from the long-term perspective, it is a very opportune time to be building a position, but I think that you might have to hold your nose for the next 6 to 12 months until you can see the deck reset a little bit more.
Okay. I have a very long-term view, and Pat a long-term view.
Yeah,
He
I
does
bought
now.
I bought Livent at the IPO. It's around the IPO, so it was $17. It's now, you don't exactly know what it was. I forget exactly because they merged now, but, Albemarle, Roddy and I interviewed Luke Sam in the middle of 2019, and the stock was at its bottom around 50, which was lower than what Albemarle paid for Rockwood. It was as high as, 330, I think, in November of last year. So between 50 and 300, over 5 years. So long-term investor, right? But lithium has proved time and time again, that you should trade the stocks, right? Not just be a long-term investor, right? Because things do get overbought. So you're basically saying, it sounds like you're saying you don't believe this rally is sustainable and there could be another leg down. This could be a head fake and you might be able to pick up Albemarle cheaper in 6 months time or Arcadium.
I think you asked earlier I think that we're entering this market where you really have to be selective on who you're investing in right now, which is why we favor Arcadium right now. I think
That's your top pick. That's your
that's our top pick in the lithium space.
Why?
Why? For one, like right now, you think about like business cycles. The worst possible situation you could be in right now is a developing producer that just started producing, right? Because you're going to be in a negative cash margin and you're going to be burning cash at a precipitous rate and you can't stop. If you're a developer that's bringing on something in 2028 and you're already funded, you're completely agnostic. In fact, you'd probably love to see your competition that's out there now dying, right? So if you're a Lithium Americas or even like a Lithium Argentina's, which is like ramping right now, there's a lot less capital risk to what you're going to be enduring over the next couple of years. Obviously, with Lithium Americas, it's a different story because you're going to be much more contingent on DOE financing. But in the case of Arcadium, for instance, which is a larger cap incumbent producer, our belief is that you have this coincidence of you've already spent money expanding Salar Hombre del Muerto. They're delaying that second phase of expansion. You've already spent money expanding Olaroz. You've already, started spending money at Nemaska. Wabuchi is being pushed out now 6-9 months. You have flexibility with pushing out James Bay. And all of this to say is if you look at their guidance from last week, they have the ability, especially with the pro forma cash that's $892 million at the end of the year with the Allchem deal pro forma. Arcadium now is going to outspend maybe $150 million this year. So you're never running into a situation where, there's some fire alarm bells going off here, or you need to raise external capital. You can make it through the other side where a bull market is going to be inflecting. And then behind that, you already have growth that you've been investing in. So we look out to 25 using more mid-cycle pricing, and we see this stock trading closer to 6.5 times EBITDA on 25. We contrast that to the larger incumbent like Albemarle, which we're more market perform on right now. Because as you're commissioning new conversion facilities, you end up being in a higher cost period of time, and you're going to be reliant on more feed to hit customer qualifications and commitments. And there's a little bit less flexibility with what your spending profile is now. And I think that's going to be one of the questions that Albemarle is going to have to answer in the next couple of years is, can they get to a level where they're actually spending within cash flow and they aren't increasing their leverage ratios?
Jumping in here from the editing room to tell you about Lithium Royalty Corp. Lithium Royalty Corp is at the center of a global energy transition and manages a globally diversified portfolio of lithium-focused royalties in electrification and decarbonization. With 32 royalties on 29 higher-grade, lower-cost projects from exploration to production, LARC covers all the bases with well-managed risk, ESG considerations, and a scalable royalty structure. Lithium Royalty Corp is traded on the Toronto Stock Exchange, ticker symbol LIRC. To find out more, visit lithiumroyaltycorp.com.
The reality is with lithium in the infancy, and with a very high compound growth, but we've seen massive volatility in, shall we say, spot prices, in contract prices. They might have floors and caps and a slightly different profile. How do you look at the valuation multiples of these companies when we're in an earlier phase and we've got much wider volatility than an iron ore or a copper or what have you?
Yeah, it's a great question. And I think we talked about this, when pricing was $80,000 a ton in the spot market of these names are like discounting $20,000 a ton. And like, why aren't they discounting 30? It'd be a home run. And I think at the end of the day, the market is still a baby, right? But you're 1,000,000 tons a year right now. That's triple what we were a couple of years ago. You're going to triple again in 7 years. So maybe you'll be a big baby by 2030. But I think that you have to pick a point again where it gets back to like incentive cost curves. And I think if you look at every single project, there's a difficulty with assessing Chinese lepidolite because you're going to have a large portion of that market that's going to be price agnostic because they're vertically integrated all the way up to the battery manufacturer. However, you're not talking about 1,000,000 tons of LCE equivalent on the lepidolite side. I think that you have to look at things assuming a mid-cycle price, whether it's $16 or $18 or $20,000 a ton. If you start running through that math, honestly, through most DFSs, you're going to find negative IRRs. And, I think when you're assessing real value here, it's pick a point, choose your production levels, flatline it now for several years and apply your long-term price to it. And that's how you can find a good pivot point around intrinsic value. And then if you feel like near term, there's something persuading you to be much more optimistic or pessimistic than that, then trade around that level. That's how we determine our price targets. That's how we set it, like what our net asset valuations are. But, I think every day, I don't think over the last couple of years, the question of what incentive pricing has changed at all. I think it's just, you've seen that near-term volatility of supply coming on the market when it wasn't needed. And you've seen demand spikes at times that were unforeseen, but I don't think you've changed the underlying economics in the industry.
So David, as a follow-on, part of what we've seen here is China's reaction to the IRA, to European initiatives, etc. So they've got the Guangzhou futures physically settled. You've had this lepidolite brine, etc. Does the increase in Chinese activity, if you look at how much is produced within China, it's picked up again. Does that again affect how you, with your evaluation multiple on an ex-China company?
I think that to some extent, I don't think that it changes very much because, again, these are going to be global companies like Albemarle, Arcadium. They all have operations in China as well. And even if you're serving the Chinese market, there can still be quite a bit of margin growth experience there over time. Despite the fact that China's domestic production is going to increase every single year and their market share is going to be growing, I don't think that necessarily increases, the risk factor applied. If anything, especially as you go through election year, like the more control that China has over the market, the more increased geopolitical risk that you have investing in a space like this. And if there's any sort of supply disruptions in any part of the value chain, that creates, I think, an interesting risk factor to consider when you're investing on the lithium side.
And if I were to ask you, in terms of making OEMs and EV offerings competitive, what do you think is the look-through lithium price, which is a ceiling above which the economics, the companies lose money it doesn't work. We know it's well below 80, but what's that? What's in your mind that number? What can they bear? What can they bear for everyone in the food chain to eat?
I still think that if a North American OEM can produce a battery, sub $100, that you can be cost competitive with an ICE vehicle over time. I think at those levels, you can still allow for very healthy mid-20s to mid-30s, per kilo LCE pricing.
Okay, so that's consistent. If lithium could somehow kind of like level off at $25,000, right?
I mean, somehow double from here? Yeah, that'd be,
yeah, and just stay there, right? Like because it overshoots on the downside, it overshoots on the upside. I'm not saying go to 50 or 60, but just like be more predictable and level. Then I think higher multiple should ensue for these companies because you're going to have less volatility, in their earnings.
So that raises an interesting point that Rodney brought up, which I think is really something to be monitoring in the next few years, right? Is that you guys raised the point that like the Chinese portion of production in the market has increased precipitously over the last year. You've had the Guangzhou Futures Exchange. You've had much more volatility of the spot market. Coincidentally, right after the time where every major producer tore up their fixed price agreements and floors and collars and ceilings and went to spot pricing. That's not necessarily a coincidence, right? So I think that as you evolve through this and you start talking through customer relationships, I think that the GMs of the world still value surety of supply. And I think that they would probably prefer to pay a fair price. So I think it'll be interesting. Arcadium obviously still has some fixed price agreements that they've set at what they believe the incentive price is for the industry. And I wouldn't be surprised if we see another round of some sort of negotiation, especially with large offtake customers, to institute more of this collared strategy that would reduce that volatility band. Because obviously going to 100% variable pricing is not the best way to protect your investors.
No, highly variable pricing is commodity like pricing. That's like Chris Ellison, Minres. He wants to be at like iron ore, and he doesn't get a specialty chemical multiple. He treats it like a commodity, and that is what by moving, as you said, to variable, as Albemarle did, has increased the volatility of their earnings. Another reason for them to have a discount is you say they're global companies, but their operations are in China. Their operations are in Chile. In Arcadium, in Argentina. So these are risky emerging market, discount, and if the demand is all out of China, which is opaque, another reason, for a discount. But on that, I do want to just, again, the earnings have come out. You do have specific recommendations. I want to go through like what you've written in your research,
Sure.
which you did for Arcadium. What's your sense? So on Arcadium, Paul Graves is now the CEO, on the call. Now he's dealing with Australian analysts who are covering, Allchem, right? So that's a new dynamic for Paul to be like interacting with. These guys know lithium, and the way they look at lithium is different than, the Western, like analysts like yourself who are not as well versed in, let's say mining, et cetera. Plus, Allchem is a 15-year-old company, has large retail shareholder base, in Australia, but it had some institutions who were like against this merger. It wasn't like I'm hearing, our listeners and viewers, from the Arcadium side, some of them didn't love the merger. And from the time it was announced to the time it was actually consummated, this was supposed to be two $5 billion companies, merged to 10 billion and it emerged as one $5 billion company, which reminded me of when Western Lithium and Lithium Americas merged. It was a 75 million, 150 million. 5 months later, it was 75 million again. And people said back then, congratulations, you now have two unfunded projects, right? And you could argue that that's the case, with in Quebec, with Arcadium, right? Like they now, it's a bigger company, it has more resources, but Paul Graves is now managing, many, many, many projects, including, Hard Rock, which has not been, in a historic sweet spot, of his at FMC or Arcadium. What are investors, are you talking with investors in Australia, now that, this merger has happened, and just the comment on, the dynamic within the share structure now, of Arcadium, and how that might or not might not impact, the share price dynamic.
Yeah. So first off, I'd say Australian investors have mandates, especially on the institutional side, to invest in Australian companies. So once this merger was consummated, I think you've already seen a lot of Australian holders that are out of the stock simply from the fact that it's not domiciled in Australia anymore. Second, like Australian analysts and I think Australian investors, they're much more used to, I think, looking at lithium through the lens of mining. And as a result, many Australian equities, I think, want to be listed outside of Australia because they don't want the mining multiple. So there's a double-edged sword to it. I think, like the Arcadium future path, one, you brought up the fact that, as you combine these two companies, they were supposed to be, this mega cap company, but this merger was also happening during an 80% downturn in the stock market. So, I don't think that this was necessarily the doings of management that caused the collapse of, the market price. And now I think you have had, I think, a tremendous amount of shareholder turnover on the go forward basis. And look, I can't say that Allchem's management would have done a better job through this downturn. It's not as though there would have been better cures, and they would have definitely had to have pushed out James Bay development. And especially if there's no visible conversion facility along with it. And Arcadium offers them the potential to co-locate something at Bécancour to convert both Whabouchi and James Bay. I think there's a lot of logical synergies with and timing that appropriately. I think that you would be insane to bring on a spodumene project in Canada and just send everything over to China to be converted, especially in such a tenuous market like the one that we're in today, or if you're going to be in one that's fairly balanced. You've already seen Arcadium obviously cut back production at Mount Cattlin and try to focus on improving cash costs there. And, look, you're already in, I think Paul acknowledged on the call, you only have 2 to 3 years left of mine life there. So why waste it when you're generating negative cash margin? I don't think that there's a whole lot of credible critiques that you can take with what Paul Graves and his management team has done with the pro forma, considering that this deal just closed. I think that there are quite a bit of synergies, especially in Argentina. You're literally in the same brines. I think taking a step back and delaying some of the expansion so that you can see if you can find more optimized ways to do this over time is going to prove itself out. And by the way, even in their low cycle case of $15,000 a ton LCE, which is not too far out from where we are today, you're still looking at mid-30s EBITDA margins. That's not a bad place to be for a business.
It's a very good place to be. And Albemarle also put out, a sensitivity analysis, $15,000 to $25,000 a ton. So your skepticism on Albemarle is that there's just more capex and execution risk, consuming free cash flow than at Arcadium.
I think it's a skepticism. I think that there's a relative value argument. We show Albemarle trading at many multiples above where Arcadium is, but I also think there's a coincidence of where you're at in your business cycle right now. And, undoubtedly a lot of the growth that Albemarle is experiencing right now is on the conversion side, which inherently is going to be lower margin in the market like this today. There is quite a bit more outspends this year. I think they're trying to offset that with some working capital releases this year that hopefully don't have the outspend as significant. They're still targeting a 10 to 20% type of growth CAGR. And I think that assumes that Wodgina continues to expand. It assumes that Greenbushes comes back online to full capacity and continues to expand. You already have the Solar Yield Enhancement Project in Chile that's being baked in the growth numbers over the next couple of years. And then you have longer term ambitions about, would you build a facility like the Richburg, South Carolina Megaflex facility in an environment like today? Probably not. So I think that there's just a lot what ifs in the Albemarle model that probably require a higher lithium price to really be confident in Albemarle relative to an Arcadium right now.
Okay. And what's your target price on Arcadium?
Well, it's $10 a share. So you're at,
More than
475 or
double.
something.
More
Like
than
that.
double. Okay. And Albemarle?
And $130 a share. You're at
130.
roughly,
So we're already
yep.
at that. So that's really, wow, that's a big difference. Okay. If you're just going to hold one, Arcadium, you think is going to double. These are 12-month targets, I assume.
Yes. Yep.
Okay. So let's talk about Piedmont, which was your top small and mid cap pick for a long time. And we're an advisor and big shareholder, or I have been, shareholder in Piedmont for some time. Talk about long-term investing. I have taken some profits along the way, but there's big fear of dilution at Piedmont, which hit the stock precipitously. As everyone was speculating, Arcadium, they shut down Mount Catlin. Corp shut down Finis. There's an ongoing fear. Will they shut down North American Lithium? You downgraded Piedmont ahead of the earnings announcement. You've now listened and participated and asked questions, of Keith and Patrick. And then you published a note. So could you just articulate, what is your view, on, after the sell down of Sayona shares, what their cash balances are and, what's your recommendation for, should we be buying Piedmont?
Yeah, sure. Look, Piedmont's fates are going to be tied to the fate of the lithium macro. And I think if you rewound to when prices were, spodumene concentrate, it wasn't too long ago, it was $2,000 a ton, right? And they had a locked in floor price out of NAL at $900 a ton that they were paying on the cost side. So if you're going to make an $1,100 a ton, $1,000 a ton spread on 113,000 tons a year of their offtake portion, you had a pretty healthy line of sight to the amount of EBITDA and cash flow that they were going to be able to use in order to funds, not just to build out of Ewoyaa, which is not substantial for them over the next several years because FID isn't expected there until 2025, but also certainly longer term with Tennessee Lithium. And I think, look, the fact is today, with spodumene pricing sub $1,000 a ton, until their offtake agreements kick in with LG and Tesla, and they're delivering at more favorable pricing. I think you're going to experience, obviously, this quarter was weak just from a pricing adjustment perspective. That's going to continue into the first quarter, and I think Keith has taken very proactive actions to basically just play defense and elongate the balance sheet. That's why you would sell down, your non-core equity stakes, and obviously Sayona, sell them down in Atlantic. And I think the combination of them, I want to say that they have something around $70 million pro forma on the balance sheet of cash. I think he outlined, laid out a plan where, capital spending this year is going to be somewhere in the $30 to $40 million. So obviously, there's some time element there where, without external capital in this environment today, it's going to last them a couple of years until he'd have to tap the market. So I don't think that there's necessarily a credible near-term fear of dilution, but on the opposite hand, to get out of where they are today, you are going to start needing to see a source of cash flows. And to your point, we don't know what's going to happen with NAL. You have Sayona and Piedmont, collaboratively reviewing operations there. I think they both said that they're focused on getting costs down by, I think, building a storage dome. I think that there's many things that they're looking at, but ultimately, if price persists where we are today, if you don't get some sort of correction, I think they are going to be faced with some pretty hard questions around, do you curtail production? Do you go into care and maintenance? And I think there's a lot of elements on what's at $13,000 a ton, $14,000 a ton. You're not going to build Tennessee Lithium today. It's not going to make economic sense to do. Carolina Lithium, I think it is still facing obviously permitting questions. But ultimately, look, this is a stock that can play defense for a while. And many of these names we talk is you're below the incentive cost curve level now. So now it's a question of duration. And undoubtedly, we think lithium pricing is going to be higher in the long run. They just need to figure out a way to get to the other side. And I think that they're doing that. But, if you compare it to other relative investments right now that we cover, I think it's fair to say that you're taking less risk, certainly with other names like Arcadium or those that haven't necessarily started producing yet, which, is just coincidentally unfortunate for Keith and the Siona folks that just brought on NAL last year.
So there's more risk in a company that's in construction than there is in something that's longer dated. But like Lithium America's Thacker Pass, okay, they haven't announced their earnings yet. They say they're in construction, right?
Yeah.
But they're not really in full construction, right? Because they're
Right.
waiting to get like fully funded. So, what's your price target on Piedmont?
Yeah, $20 a share. Yeah, so
$20 a share, and it's
Thank-
$13.5 now. So nearly a
Yeah.
double.
Yeah,
So
but the magnitude of the drop, I think, has even surprised us as we took a more cautious stance. But obviously, there's a lot of questions that need to be answered out there.
and the $20 is based on what? Is that a multiple of EBITDA? In
No,
the
$20 is based on if we assume like our long-term pricing achieves $24,000 a ton, and you build out Tennessee Lithium over time, and NAL's back to producing a spodumene concentrate that's selling, in the high, call it $1,800 a ton range, or choose whatever multiple you think is appropriate relative to chemicals. It would be just blowing down those cash flows over time on the development side, and obviously develop a Uia in the same framework. And we don't include Carolina Lithium in that valuation right now.
How would you value that if it were to come through the permitting?
We have in our model what we think, Carolina would be capable of doing. But the combination of building a mine and then obviously building a conversion facility on top of that, I think, keeping in mind, it's not as though the company can afford to do multiple projects right now without multiple loans. I'd have to look specifically at my model for where that would be. But if you've got a permit, that's going to be a significant positive catalyst for the equity.
I would view the way I view it is my own opinion. I don't know that I'd give any value at the moment for Tennessee or even Carolina. Ghana, you can value relative to where Atlantic is valued, but on the North American Lithium, if you think $1,800 spodumene is possible by 2025, 2026, and then that this mine survives, you just do the math. That's a couple of $100 million of cash flow. It's trading at a 250 million, market cap. It's 1 times forward cash flow. So if you actually take a view, I believe spodumene prices are going to, be this price. And if you look at other companies like Sigma Lithium or Pilbara, there's an implied spodumene price in their valuation. And if you think Piedmont's not going to have to dilute because they have sufficient cash, and North American Lithium survives, that's the big question. Does North American Lithium switch off? Are those cash flows? And Keith was quite optimistic, I think, articulated an optimistic view. They haven't just made a decision, but seems better than 50%, that with this crushed ore dome and the recoveries, that their improved recoveries, December was the best month, ever for production, that this isn't like a Finniss-like situation or core Finniss-like situation.
Yeah.
From what I'm hearing. And James Brown at Siona, hats off to him. He's done this before, with Altura.
Yep.
He's built mines. Okay. So, but Lithium Americas, which is trading at 650 million market cap, right? They have a binary outcome here, don't they? They get the loan,
Right.
The market's pricing in a high probability, not only that they get the loan, and then they get the, further GM investment, right? But then what happens, right? Like, what's the number of years of construction? So like, what's your target price on Lithium Americas, and how do you model?
We have an $8 share price target on Lithium Americas, and
It's also nearly a double.
yeah. So
Okay.
if you, and again, I think it is highly binary on receiving a DOE ATVM loan, right? And that application has been in the works now for, well over a year. I think that they're probably the most advanced of any of the upstream side of a loan of that scale with the DOE. I think that they're at the final portion of just crossing the T's at this point. The DOE needs to get over the hurdle of one, just execution risk and operational risk, in addition to economic risk. Again, remind everyone, the DOE is not issuing charitable grants. They need to get paid back on these loans. And these loans are quite onerous and in terms of being the most senior portion of your capital structure, et cetera. Obviously, once you receive a loan from the DOE, for lack, that would trigger the second tranche of investment from GM on the equity side. And when you get back to economic considerations, GM provided a floor in their offtake agreement with Lithium Americas at Thacker Pass. So the economics for the DOE shouldn't be a concern. They've obviously been out to the mine and they've had a pilot plant running in Reno now for some time, and I think have a demonstration facility. So presumably it's gotten past the execution risk, not to mention the fact that the DOE has written billions and billions of dollars to loans that I would argue for companies that are far lower quality than Lithium Americas, but we don't need to go into that right now. So I think it's a matter of, and that's not on the lithium side, by the way, but as a digression, like, this is a binary outcome. I still think that you should have extremely high confidence that this loan is received. You can question what the proceeds will be, right? I think the expectation is that you're going to be $1.75 billion, $2 billion. But at that point, then, to your point, yeah, you're going to be in construction mode for a few years, but you're going to be fully funded. So I would expect that if they get the loan, the stock appreciates towards where my price target is of $8 a share. And then from that point, you're going to be somewhat of a function of lithium macro and the pace of development on the construction side. And right now, you're really just in early works construction.
Okay. So basically, you think the stock doubles on the catalyst of the high probability that they're going to get a very large DOE loan and not need any more dilution other than, the GM portion.
That's right.
Okay.
Look, it's even if you need to raise $250, $500 million over the course of a few years, you wouldn't necessarily need to do that today. And it's not to say that, if they receive $1.75 billion and they need $2 billion to make ends meet with that project, you're still in the game and you're practically fully funded. You can bring in more partners. GM can come back. Like, they're going to own a significant portion of this company going forward once that second equity tranche comes in. So I think if you de-risk the financial side of the business with that loan, then very confident you'll see, almost a double in the equity.
Okay. And Lithium Americas Argentina, they have not yet reported. They do have a new CEO, a good friend of mine, Rodney and mine, Sam Pigott, who is 6 years at Ganfeng. So have a very high degree of confidence in him as a human being. This is a gigantic step of a role for him to be CEO. So I'm looking forward to watching that. But he knows Ganfeng extremely well. Ganfeng is the 51% operator of the Caucharí-Olaroz, but LAC also owns two other assets. So what's your target price on Lithium Americas Argentina? Full disclosure, I bought Lithium Americas Argentina a couple of weeks ago for the first time I'm back in the stock in 3 or 4 years. And by the way, just all these stock ideas, David is an institutional sell side analyst, but nothing here on Rockstock channel is not financial advice. He's not giving financial advice, but he does give institutions this advice, and all of these targets are in the public domain. So Lithium Argentina, your target price is what?
$6 a share.
So lower than Lithium
Americas,
and they both have around the same market cap, right? Lithium Argentina, I think, is around 600 million market cap. We could argue, I argue my rationale for buying was that I think it's trading at kind of replacement value with Minera XR, the joint venture having $1 billion spent on it. And then it could take the other two assets from Millennial and Arena, for another $100 million. And they're in production, and they have cash. I don't know what their debt is. Do they still have debt? They inherited the convertible debt or some debt from
converts.
from Ganfeng. So why is your target price only a little bit above current price?
Yeah, look, I think it's just a matter of the on a gross basis, the two companies should be producing the same, right, over time. Lithium Argentina's obviously has half of most of their properties, outside of Pastos Grande, which, I guess we'll see when they get around to developing that. And I presume at some point they'd need to bring in Ganfeng to help them finance that. I think it's just a matter of playing like near-term catalysts. Like if you run through like a full net asset valuation at Thacker Pass, if you get past financing, we think that it's worth at least $8 a share. And part of that is, you're in an IRA compliant jurisdiction. You obviously have an offtake partner with GM. Lithium Argentina's, look, I think that there's a lot of reasons to be optimistic, and obviously they have Ganfeng as a preferred financing partner there. So I'm sure that as you get to Caucharí-Olaroz Stage 2 and look at expansion there, there's going to have some help with the financing side with Ganfeng if they need to. But I think like you just get a much larger exposure to those LCEs through Lithium Americas, provided that, of course, that they get a DOE loan. If loan doesn't come through, then that $8 price target is going to be invalidated.
What do you think the downside risk to Lithium Americas is if they don't get the loan?
Yeah. If you don't get the loan, it's not as though you go bankrupt because you're not spending money right now. You can, you don't have to be doing anything. You don't have to do any early works construction. You obviously have cash on hand, but you're going to need to find like a significant equity financing partner. And, obviously it's going to be up to GM at that point, I would think, what they want to do and, how significant of a stake they want to take in actually financing the property. If GM wants to foot the bill for the entire, Thacker Pass and arrange some sort of financing arrangement that way, that's certainly an option. But, of course, if it is confirmed that a DOE loan was rejected for Lithium Americas, don't expect the stock to stay exactly where it is today. Yeah.
That's a huge downside. But in Lithium Argentina, presumably there's a lot less. But you basically think it's Argentina, it's controlled by a Chinese company, right? So the exposure and the EBITDA, forward EBITDA, which is your main focus, is overall.
Lithium Argentina's is not controlled by a Chinese company. It's the
no, okay, but the main asset, the main asset is.
Yeah. Yeah. And that can obviously be a benefit, and it can be a detriment to value depending on how you view it.
Yeah. It's not I'm not denigrating at all, but you have in Thacker Pass, you have, made in America, it's all America, it's huge, DOE,
Yep.
Going to supply that, in Lithium Argentina, your partner is Ganfeng. They 20%
supplying
or
Ganfeng.
20-year offtake, for the first half and 51% ownership, which is a fine thing. Like for some
Sure.
people, like that's good. You want to partner with Ganfeng, the best operator in the business. But your exposure to it is, what do you think the probability of, Piedmont, Lithium Americas or Lithium Argentina is for a takeover? If you were to put that as an option.
Let's look at takeovers that we saw from last year, where you had plenty of folks that felt like they still weren't getting, credible value for the companies that they were selling, right? To see a takeout now, I think it obviously would be like an element of distress of just someone just throwing in the towel, and tossing the keys. I would say that that's extremely low. I would think that if you're a management team right now to sell the company at what you would presume to be the bottom of the cycle, you would much rather prefer to wait things out unless you absolutely needed to. And I think in all three of those cases, there's no impetus to do anything right now. And there isn't necessarily a strategic reason for someone to pick them up right now at a price that would meaningfully exceed where they are today.
I was more thinking kind of medium to long term, not so much immediate term. Do you see GM in LAC's capital structure or Ganfeng in Lithium Argentina's capital structure as any impediment to a prospective takeover, versus, let's say, Piedmont, which,
not necessarily. I mean, I think the only difference with GM and Lithium Americas, for instance, right, is that you have a singular project right now in the United States. and you have one offtake customer. So this does another mining company or another lithium company want to own something like that, where you have one customer, perhaps, but at a certain level, like how much value can you create with an opportunity like that? I think there's still going to be quite a bit of interest over time, and looking at some of the more diversified names. I'm sure that Albemarle Arcadium, I think, is still going to be a very interesting takeout candidate for a variety of folks, just given their upstream footprint, especially as they develop Canada. Look, Lithium Argentina's, you have a partner right in your backyard that obviously is as the largest converter in the world, would probably look at acquiring you over time if the deal made sense.
And if the Canadian regulatory authorities would allow it.
Well,
Or maybe they could do it at an asset level. Okay. And finally, you cover Lithium Royalty Corp, a sponsor of Rockstock Channel. What's your target price on that company, and what's your investment thesis for why investors should own that?
hey, $10 a share right now. And I think if you looked at LIRC's portfolio, there's been a selection bias to, I think, very high quality projects with well-funded developers, and pretty attractive jurisdictions, right? And I think, as certainly with the Lithium Royalty Corporation, a royalty structure is one that they don't really bear financial risk through a bear market. They obviously will have less cash flows, but the company was already in its infancy. You only really had, Grota de Cirilla with Sigma, Mount Catlin, online this year. So it's like, as you have this sort of wedge of projects coming online in 24, 25, you have Mariana with Ganfeng, you have Atlas Lithium's project in Brazil and Minas Gerais towards the end of 2024. You have obviously Sayana and what's happening at Moblans. They just put out that PFS the other day, 900 million and change. And then obviously you have very attractive exposure to Winsome Resources portfolio. So I think you have a number of projects where obviously the lithium macro is going to be weighing on how you think about the valuation, but as long as you can develop those projects and bring them online, I think they come out of the other side of this looking pretty attractive, not to mention the fact that non-dilutive financing sources like royalties tend to be pretty attractive and pretty opportune in bear markets like now. They made a number of acquisitions last year. I would surmise that they're probably going to do some things this year as well.
Okay, that sounds great. So it's a way, rather than just buy an ETF of, junior miners or junior and senior miners, this is a way to play, an actively managed portfolio of largely hard rock assets, but high quality ones. And you mentioned the main drivers for it. Mount Catlin actually is going to be small, but if you believe in Sigma, that's good. And then down the track, you mentioned some Atlas, Mariana, which doesn't have that much of a profile, but Ganfeng controls that could be interesting as well.
With something like a royalty corporation, how do you, if at all, adjust how you value it with a changing interest rate environment? Do you see it as a yield play? How do you compare it against the straight equity?
Yeah, sure. Any royalty company is inherently a yield play over time. And you look at the amount of distributable cash flow and periods of, higher interest rates. Obviously your yield has to be a bit more competitive. But again, we tend to just use a net asset valuation of what we think, like royalty companies over time, tend to trade in parity of NAV or premium to NAV, just given some of the scarcity value of the projects that they have. So we look at that as like an interesting precedent of a way to start. And you have a full calendar of all the projects that they have coming online, and they're in their portfolio. And that's that's how we prefer to use it. The higher interest rate environment really just influences the discount rate, which for a company like this, you're already using substantial amount of discount rates in the project, since many of them are so far out and with, many developing names.
Thank you very much, David, for joining us again on this Tuesday afternoon and updating us post earnings and sharing your views on the, not super yet optimistic. If you were optimistic, we would be, closer to the end of the bull cycle than the beginning.
I'd like to think that, at least from my seat, that if I was optimistic that we're at the beginning of the bull cycle, but that's fair. Yeah.
Okay. Depends on your time horizon. So we shall see. Thanks again, David. And I look forward to catching up again sometime in the not too distant future.